Important, though, to state that both CPUs and GPUs are silicon-based microprocessors, and they are both considered semiconductors. So for a lot of like the investment hype we've had in the last year or two, you hear people talk about, oh, this is a semiconductor play or whatever, but you actually do need to be quite specific on what type of semiconductor it is. And this does seem to be one of those instances in which if you want to invest in the space, you kind of have another level of due diligence you need to do just to make sure you have clarity on what exactly a company does.
When a company blames the weather, is it only something that's so far out of your direct influence? I mean, think about inflation and interest rates. It smacks of there's nothing we can do about this. And I think the real reason for this is mostly competition in the payments sector is increasing. There is no short of payment tech companies out there. They're growing.
NVIDIA is growing. Like it has a significant amount of growth for something, that's chip based. As I mentioned in the last segment, this company isn't really growing. It is becoming increasingly profitable and it is expanding out its margins and it's incredibly dominant, but it almost looks like a value stock. This is not a growth stock. You can't have a 1% revenue decline and say we want to trade at a valuation of 122.
I just want to give a quick word from our friends and sponsors at Vodafone Business. I used to think of Vodafone Business as only a reliable provider of mobile and broadband needs, but they're really stepping up to help Irish businesses grow and flourish in an increasingly digital world. So they now offer a whole array of digital apps, from productivity tools and security solutions to IT support and even website builders. More recently, Vodafone have launched their VHub digital advisory service. With its new service, Irish businesses of all sizes can get free one-to-one digital support and advice tailored to their business by simply booking a call with one of the VHub digital experts on the Vodafone Business website. Search Vodafone VHub for more information. Marie, Emmet, welcome to another episode of Stock Club. Good to have you both on. We're going to kick off this early morning recording with the quiz, just to get you on your feet early. So I have two companies here, and you have to guess which one is which, okay?
Mm-hmm.
So Company A has net income of 4 billion. Company B has net income of 4 billion. Company A has sales of 25 billion in the last year. Company B has sales of 28 billion in the last year. Company A has a profit margin of 18% and Company B has a profit margin of 14%. And now here's where it gets interesting. Company A has a market cap of $1.1 trillion and Company B has a market cap of $66 billion.
Well, there's only a handful of companies in the $1 trillion club, and until you said that, I thought it was going to be Cisco and Cisco, which is the router and gooter crowd, that's CISCO, and then the food delivery crowd, SYSCO. And they always had this incredible, almost Twilight Zone parallel existence, right to the point where one of them had the CEO called John Chambers, and the other CEOs was called John Chambers. And it was kind of like the talk of the investing community 20 years ago. But anyway, a 1.2 trillion behemoth and what was the other one? 60, what you say, Neil?
66 billion. And they have the same profit, sales and income and margins.
Wow. Well, I'm going to go with NVIDIA for the big one.
NVIDIA was Company A and Company B has been...
Is it Qualcomm?
No.
Whoa.
PayPal. Yeah, PayPal has almost the identical numbers to NVIDIA at the minute. That is nuts. The price to sales goes from 42 to a nice 1.7, I think. So
wow.
Yeah.
Wow.
That's the stage that PayPal has gone down and NVIDIA has gone up in the space of last 2 years, maybe.
Wow.
Yeah, it's wild. Okay, let's get into the show. Emmet, you have a story for us today, and it's described as the greatest con in Silicon Valley history, which is kind of a big opening statement. It's like the greatest goal in the new camp, It's like of a place where there's a lot of cons, we've got the best one. So it's always fun to go back and visit some of the bizarre stories that have happened over the dot-com era, and the company you picked out is Pixelon. So what's the story behind it?
Yeah, Mike, Anne-Marie and listeners, sit back for a wild tale. At the time, in the late 90s, there was a whole load of companies out to change the world through this new technology called the internet. And as we all know, several got it right, like Google and Amazon and the likes, but a whole pile got it very wrong. And very few companies did wrong more than Pixelon, which was one of the late 90s tech boom's greatest startup catastrophes. And I definitely thought it was a story worth telling. And I'm pretty certain that 95% of our listeners won't know of Pixelon. Did either of you guys hear of Pixelon before I said to you, hey, let's have a chat about it?
No.
Okay, good, no. Great.
Well, and I've been looking up at this stuff as well, yeah.
Totally. Well, okay, you're a pair of stock nerds, so if you haven't heard of it, I'm comfortable that our listeners, who are also stock nerds, probably haven't heard it. So as a prologue, it's worth setting the scene to remind our listeners that to build a successful tech company, executives not only have to sell their product, but they also have to sell themselves. And Pixelon was founded by a guy claiming to be called Michael Fenne, who wooed investors into pouring money into a company that promised to put streaming video into everyone's internet browser. And that was a really profound concept in the late 90s, like pulling video off television and turning it into a file that can be played over a computer is no small feat. Even today, like technically behind the scenes, there's a lot of stuff happening. So let alone in mid to late 90s, 1997, this was a really big promise. Like the amount of information carried in a typical video is so vast that it would take a day or more to download a 30-minute sitcom back then. Most people still reach the internet through this noisy modem, and if you were a web surfer in the late 90s, you'll always remember that sound of a dial-up and this kind of whiz-burr noise that accompanies every internet session. And even like grainy images would take 10 minutes to download. I remember the first time I encountered the internet, I was in Dublin City University, DCU, in probably about 93, and it was horribly slow with no images. So like a couple of years later, you could download an image and it would just build one strip at a time, and really images on the internet were just not a thing. So kind of when you transpose that onto video, this was a big promise. Okay, so Fenne rounded up a team of engineers and named himself the CTO for a streaming video service. And so ambitious was this vision that it would have been beyond groundbreaking. Like Netflix, just for context, didn't even stream until 2007. So this vision, if you like, was 10 years ahead of what transpired to be reality. So at first things were looking good, and the former print and now online journal Wired said that by December of 1998, Pixelon was, quote, announcing that Paramount Pictures picked its technology to use in the online promotion of its latest Star Trek film. As a startup, Pixelon attracted plenty of attention from venture capitalists. The company's technology struck a chord with early stage investors who saw much market potential for applications for clear, faster video speeds over high-speed internet connections. So that was the vision, and that was the promise, and that was the business. Now, apart from there being three pillars to investing in a company like this, which are the technology, the intellectual property, and the team behind it, back then anyway, there was also a pretty important part of any tech company. That was the launch party. Now, on this particular checkpoint, Pixelon was the stuff of legends. In October 1999, to showcase its technology, it threw one of the most lavish launch parties in tech history, which they called iBash 99, and they held it in Las Vegas. The event cost $16 million, right? And featured performances like from The Who actually reformed for the gig, Kiss, Faith Hill, Dixie Chicks, like these are big, and Tony Bennett. I mean, Tony Bennett, that's a triple A-lister right there. And 16 million, that was nearly all of their money. Can you just imagine getting a $20 million or so check or $18 million check? And okay, boss, what do you want us to do with it? Is Tony Bennett still alive? Yes, boss. Get him on the phone. But no, I want Tony Bennett. I want a live gig from Tony Bennett. But boss, I don't want any buts. Just get me Tony Bennett. Well, All that is fine, as the event was, I suppose, aimed to demonstrate this superior streaming technology. And they decided they were going to broadcast all these major A-listers over the internet. So it starts to make a little bit of sense when you think, right, if you really want to get eyeballs on your tech, you get Kiss and The Who and Tony Bennett and all these people, and you broadcast it live. And the company announced that it was going to be on Times Square. They had this huge, giant, super giant screen in New York, and it was going to be an 8-hour live feed. This was absolutely ginormous. However, the live stream displayed error messages to the thousands, and it was really only thousands of people who had dialed in to watch the event. And in fact, anyone who got to see it online ended up using Microsoft's streaming service instead of Pixelon's. So just to be clear, not one single frame turned up via Pixelon's tech platform. So it didn't even nearly work. They had Tony Bennett there sitting there singing out, crooning away. And if you were watching it online, which wouldn't have been a great experience anyway, you were doing so with Microsoft. So alas, as they say in Hollywood, the plot thickens. As this technological failure became evident, an even far more shocking revelation came to light. Pixelon's very charismatic founder, Michael Fenne, was actually a fugitive named David Stanley. This employee of the company noticed his resemblance to a notorious con man on the run from the law, which made the "let's get Tony Bennett for a few songs" thing look small. I mean, this was huge. Imagine looking at your boss and going, I thought I've seen him on America's Most Wanted. But anyway, Fenne, or Stanley, as it actually is by law, had shaved his head, grown a beard, and adopted the Fenne persona to hide his true identity. I mean, this guy, as I said, was on Virginia's Most Wanted list for several years after skipping bail following a pretty big stock swindling conviction. When his real identity was discovered, he resigned in early 2000, surrendered to authorities, and left behind a company he built on tech that didn't work. And this all left the company's remaining executives scrambling to resurrect the company's image. Yet the bad news still wasn't over. 2 weeks after Stanley/Fenne's departure, creditors sued Pixelon, claiming the company never paid them for $500,000 worth of stuff, services, and products, which I'm sure is true. And their goal was to bankrupt the company to sell off the remaining assets and have first dibs on whatever's left. But through a bit of ducking and diving, Pixelon held off the death knell for a couple of years, but then eventually filed for Chapter 11 bankruptcy in 2002.
Sad day.
That's about it. I'm getting the truck rolling down the hill vibes off this guy. So what happened
exactly.
What happened to David Stanley, assuming that is his actual name?
Oh, there is so much to this guy, and I'm surprised there hasn't been, that I know of. I think there was a HBO show about the guy, but I've never seen it. And just when I was researching for the piece, I saw something was done. But according to this old article from the UK newspaper, The Guardian, published in July 2000, so it's a 23-year-old article, quote, "A hastily formed coalition of company officers and directors were planning to oust Pixelon's founder and chairman, Michael Fenne. They called the police because they were worried Fenne, a big man weighing in at 350 pounds, might turn violent."
Christ.
I know, that's quite, I mean, he might turn violent. Not only did this guy harangue workers over like the PA system, the public address system in the company, he actually made staff pray in his office, and he spent most of the company's money on this insane launch party. But then they figured he'd start swinging the fists when the cops arrived. I mean, this guy is unreal. Like, wait till you hear this. One Sunday, he instructed all employees to meet in his office for what he described as a worship service. And at the meeting, which was held in near darkness, he played the piano, sang a hymn that he had written, and his wife sat close by, wiping tears from her eyes, as witnessed by the staff. And can you imagine being there? Look, he used to sign his emails, big giant head of Pixelon. That's how he signed off his emails. I'm no shrink, but all of this is a bit unhinged to me. But I think before describing what happened to him, it's also worth describing where he came from. If I don't know, do you guys watch Sky Crime? It's a channel on Sky TV over here. I love it. It basically just streams stories of bad guys and bad people who are nuts, and there's always a backstory. There's always a backstory. Nobody's born bad, absolutely nobody. But anyway, Stanley was born into a poor rural South community, and he was the son of and grandson of an Appalachian preacher, basically, and that kind of brought his status to the family, and he used this status to and he apparently had near hypnotic speaking style. Apparently when this guy spoke, you listened. But he used this kind of charisma and his status to fleece pretty much impoverished neighbors out of more than $1 million. In 1989, he pleaded guilty to more than 50 fraud-related charges. So a judge sentenced him to 36 years in prison and agreed to suspend all but 8 if he repaid his victims. So in early 1996, having paid back only a tiny fraction of the money, he got out of Dodge and he vanished. And according to that Guardian piece I mentioned, he turned up in the sleepy town of San Juan Capistrano, do you know that place, Anne-Marie? San Juan Capistrano? So he turned up in San Juan Capistrano in late 96, just as the internet was transforming like the most unlikely people into overnight multimillionaires. His weight, which was once 220 pounds, which is, I suppose, lean for a tall person, had ballooned to 350 pounds. And he and his new wife, Sheila, who clearly loved him tinkling the ivories and singing songs of praise, lived out of their Hyundai and showered in a nearby beach. And he told locals that Sheila had recently escaped a Mormon cult, and that was hell-bent on getting her back. And he wrote a letter to his former wife, which was quite telling, who refused to go on the run with them. And it gave a sense of the man and who he is. He wrote, "It has always been and always will be a mistake to lose faith and underestimate me." He wrote, "God has blessed me with a unique ability to defy reality." So to your question, what happened to him? Wait till you hear this. Soon after the board meeting where it was decided that the big man had to go, word circulated in Pixelon's inner circles that someone had found a document on his computer laying out a detailed plan to leave the country in the event of anyone discovering that it was all a con. The letter discusses using hair dye, colored contact lenses, and that kind of stuff to create a new identity and eventually re-enter the country. Quote, "I would only do this after a face change through plastic surgery." So I don't know. Look, I mean, coming back to Sky Crime, you shouldn't write stuff down if you're a bad guy. You shouldn't go home and go, "Dear Diary." Like, you shouldn't do it. It's just absolutely, it's cracked. You're leaving like evidence. But anyway,
the O.J. Simpson book, If I Did It, or something like
If
that.
I Did It.
How that got published, I'll never understand.
Awful.
I mean, serial killers do it all the time. It seems to be a rite of passage that serial killers keep a trinket or write something down. It's just mad. But anyway, it makes no sense to me. But what I think is especially strange is that I actually can't find what happened to him after that part where the cops came into the office and took him away. It's as if reporting just stopped. And I'm sure there's better Googlers than me out there who might go into a rabbit hole and find out what happened to him. But I think there's very, very little. So when he went in behind bars after that initial arrest and was awaiting his fate, it just goes quiet. And it leaves me wondering if he somehow engineered his way out and created a new identity. I don't know. It's all very odd. I can't even find out if he was sentenced or if he had an appeal or whatever. But it seems the tale of Michael Fenne or Stanley or whatever his real name is one that just stopped from that point onwards. And thus he left behind a story of Pixelon, the original Netflix, I suppose, up in flames.
Yeah, maybe his plan worked. Maybe he left a decoy in his office.
Yeah, I wonder. It wouldn't be great to have some Pixelon. Oh yeah, sorry. It wouldn't be great to have some Pixelon swag. You know, people are like, oh, I'd love some Coca-Cola swag or Airbnb swag from the early days, but like, imagine have some Pixelon swag. That would be just brilliant.
It's probably on
A
eBay.
nice
Did you check
Enrag
eBay?
cap.
I didn't actually. I think I will after the show, because it would be kind of cool to have a Pixelon cap.
Yeah.
Walk around town.
Maybe that's how you track him down. Maybe that's his next swindle, is selling Pixelon swag on the internet.
I'd say he listens to Stock Club. Stanley, contact us. Do an interview with us.
All right, Emmet, what's your take from all of this? So, David Stanley, Michael Fenne, Pixelon, the lot.
Well, as we always say, management teams not only matter, but they're the most important thing in a business. And because you can't assess a team or a founder with numbers, it's also the hardest thing to get right. But if there was ever a poster child for the need to do some kind of qualitative assessment on a founder and her or his team, it's definitely Pixelon, as history has shown. But it's one of those really tough ones. You can run filters all you like, but then you really have to try and meet the management team if at all possible. In fact, I was talking to Chris Mayer yesterday, who some of our listeners will recall wrote 100 Baggers and Where to Find Them, and who will be discussing again via MyWallSt very shortly with what I hope is a very exciting announcement. But I was chatting with Chris, and he was talking to me about some businesses he's looking at that have the attributes of 100 Baggers. But for him, it was very important to go and meet the founders, look them in the eye, and which he did. And we had a great chat about that. So, really that last bit is very difficult for, let's say, normal everyday investors who've got a life and career of their own to do, which is why I think we need to find somebody who we trust, who can at least assess management teams, if you don't have the time to do it yourself. But yeah, the bottom line is management teams and founding teams really matter.
Absolutely. All right. So that was Pixelon, the greatest con in Silicon Valley history. Okay, we're moving on then to ARM and its recent listing. So it's going to go public in the next month. So Anne-Marie, we were talking about for a while that, we've been waiting for one of the blockbuster IPOs to finally come around, and this is it. So the chip designer has released his plans to go public in what would be the largest IPO for the last 2 years. So first things first, what exactly does ARM do?
Yeah, so ARM is a British semiconductor company and software designer based in Cambridge, England, and they primarily design CPUs. So we'll just do a bit of a difference there between a CPU and a GPU. A CPU handles all the main functions of a computer. It's very much the foundational aspect, whereas the GPU is a specialized component that excels at like running a bunch of smaller tasks at the same time. So CPUs down at the bottom, and then you build GPUs on top of it, depending on like how specialized you need your computer to be. Important though to state that both CPUs and GPUs are silicon-based microprocessors, and they are both considered semiconductors. So for a lot of like the investment hype we've had in the last year or two, you hear people talk about, oh, this is a semiconductor play or whatever, but you actually do need to be quite specific on what type of semiconductor it is. And this does seem to be one of those instances in which if you want to invest in the space, you kind of have another level of due diligence you need to do just to make sure you have clarity on what exactly a company does. Interestingly, though, ARM isn't the chip maker itself. Rather, the company is responsible for coming up with the architecture of chips. So they bring up the overall designs, including components and programming languages, and then those other companies basically license that technology and build the chips themselves. Its original value was designing chips with a very low energy consumption compared to the x86 chips, which were really common in personal computers back in the early 2000s. So this company's been around for a while. ARM used to specialize in desktop computers. So, your kind of average run-of-the-mill big screen that was probably in your dad's office that was running that really slow internet that Emmett mentioned earlier. But recently, because they're focused on kind of low energy in the last kind of 10 to 15 years, they've moved into the smartphone market, and they effectively dominate that market. They have virtually no competition. They most definitely have a monopoly. It's estimated that their market share in the mobile phone CPU sector is 99%. So truly just all out there on its own. In its filing statement, it actually said, we estimate that approximately 70% of the world's population uses an ARM-based product. That is crazy. And they said that of chips containing its technology, it had a 49% share, because it does make chips as well for computers, but that's less of a share. And its total addressable market as of last year was $200 billion. So it's a great place to be. This kind of dominance and its monopoly-like status meant that CNBC declared the company a neutral party, or the Switzerland of tech. Basically, it's just such a foundational play, really. It's very easy to invest in, I guess. And then on top of cell phone CPUs, ARM has kind of smaller developments in software development tools like DS5 or RealView or Keel brands. It also does system on a chip infrastructure and software, and it does do a couple of GPUs, which it's a much more competitive space. That depending on what type of specialized GPUs you're making, that would pull it into competition with something like NVIDIA or Qualcomm, who I mentioned earlier, who, we really associate with Apple. So that is kind of where they're at the minute. Chip designer, specializing in cell phones, bit of computer stuff down the line. But their main like revenue generation is coming from the cell phone market.
Yeah, 99% market share is always a good thing, I think.
Yeah,
I think it used to be floated before. I'm 99% sure it was floated before. Stuart Rose was the founder, and my dad was an investor in ARM. I really hope he still is. I don't know what happened in between. So I'm working off 30-year-old information, but I remember my father telling me that he bought a small amount of shares in this thing that does chips, and we had a laugh about that.
Yeah, it was privatized in 2016 when SoftBank picked it up, but it was publicly trading on the London Stock Exchange up until that point.
Any idea what happened? Just asking for a friend. So if you used to be a shareholder, it's a clean sheet, I guess.
I don't know if it was an all-cash deal. We'll find out.
Yeah, I'd say your dad's got Masayoshi-san's cash in his back pocket from it somewhere.
I'd say that's water under the bridge, whatever happened.
Yeah, so it let investors see its books up in the build up to the IPO. So how are we looking? How are the numbers going? And what market cap is it targeting to go public at?
Yeah, so actually, interestingly, we can go back and reference that initial 2016 purchase when it was privatized. Back then, SoftBank picked it up for $32 billion. At the time, it was SoftBank's largest ever transaction. And as of today, it's coming in at a valuation of about $64 billion. So nice doubling since 2016. Not bad to see. ARM reported revenue of $2.7 billion for the last 12 months. That was down 1% year on year. And its net profit fell 5% to $524 million. Interestingly, ARM actually isn't going to receive any of the proceeds of this IPO. It's basically SoftBank attempting to sell down its stake, which, is kind of a funny thing, because we tend to see IPOs, particularly in tech, where the company's saying, we want to generate X amount of money to geographically diversify or invest more in R&D, or, pay off people who've worked for the company for a really long time that hold stock. But this is kind of just an instance of SoftBank cashing in, which isn't exactly like the number one thing that you would want to see. It also revealed in its prospectus that ARM depends on China for almost a quarter of its revenue, which is not exactly as well where you'd want to be. That is actually up. It only generated 18% of its revenue in that region last year. And, when we're in a period in which Joe Biden is kind of trying to bring the chip market back to the United States, and there's been a lot of trade restrictions between the two countries, that can be kind of a dangerous relationship isn't the correct word, but just a bit of a precarious relationship. It also details a number of risk factors because of that exposure to China. ARM warns that it is particularly susceptible to economic and political risks. And interestingly, China, as it makes up such a large portion of their revenue, the cell phone market in that region has actually been declining the last 2 years. So even on top of that, there's the additional worry of, that's a primary international cell phone market. So, if sales are declining, the company's going to have a hard time. Another Chinese risk factor that was detailed in the prospectus, which also is related to the numbers, is the fact that ARM's business in the country is actually run through a local company that neither it nor SoftBank can control. So the company is called ARM China, and it holds the exclusive rights to sublicense its intellectual property to Chinese customers. That would include really big players like Alibaba. And because of this kind of, again, precarious relationship, ARM has been trying to distance itself from, it's not a subsidiary, I guess it's like a related company. And so they attempted to shift ownership to a unit of SoftBank a couple months ago, which would mean that it would only have a 4.8% indirect ownership stake. And that was also detailed in the perspective. But interestingly, the Chinese government kicked off about that and said that within their records, the UK group continues to hold nearly half of Arm China. So there's a bit of a disconnect there in between numbers and reporting financials. And that was also stated in their prospectus that they are having IT trouble. And that meant that they're apparently confused about who holds 45% of the stake of Arm China. So a couple of just points that need to be clarified, really. And then just kind of a final note in terms of the IPO, SoftBank has held talks with a number of significant players within the chip space, but also just tech more broadly. This includes Amazon, Intel, and NVIDIA. And they're hoping that before IPO that some of these big players will come in and buy up a big chunk of the floating, as I think we're going to talk about in a second. NVIDIA did attempt to buy the company last year outright. So if NVIDIA were to come in and make a large investment, maybe buy out 10%, I think that would be interesting to see and would maybe just give a bit of reassurance to some early investors.
So to summarize, it's not growing that fast. It's a really expensive stock and it's got loads of risks. Not a great intro to the public markets if you're looking for a big pop, but I suppose this going after its customers basically to become investors could be that kind of protection. So we mentioned NVIDIA, and last year they had a failed acquisition attempt for $66 billion. So there is obviously clearly value here. Do you think maybe it's borrowing from the hype? Like this is an IPO of opportunity with such hype around the semiconductor industry, and then this very close connection to NVIDIA as well, which is, as we've seen, gone nuts.
Yeah, I would definitely say so. I'd also say it's maybe preying on the fact that, as I kind of said at the top, there is a lack of clarity in the semiconductor market. I just think investors, it is a complicated thing, and it's probably, if each of us had to at some point like build a cell phone or a computer, we would be better at being like, oh, I can distinguish between a CPU and a GPU. But most people who probably come from an investing background are not doing technical work like that. So I think there is that rough association with NVIDIA, and it means that people are very, very interested, and then probably the company also want to capitalize upon that. An interesting fact, though, is when SoftBank agreed to acquire Arm back in 2016, they did so again for kind of a weird offshoot approximate relation reason, which was that Arm has a really, really small exposure to the Internet of Things sector, which back in 2016 was a really hot topic on the market. Everybody wanted to find some Internet of Things company. It was kind of like the NFT or the AI or the metaverse of the year. And so SoftBank way overpaid for Arm simply to say that they had gained exposure to this thing. And it just kind of ended up as like an accidental win for them, that the company's main business, which is cell phone chips, that's not a bad business to be in. It's just not going to be this insane grower, that SoftBank was able to generate money from that. So it was fine. So it already has had this, let's be offered at an insane valuation because of some niche thing that we are somewhat involved in. With its current financials that we mentioned, and those are approximate financials, I believe, that have come from the Financial Times. Like the estimated market cap is an approximation. I think the rough idea that I've seen reported is between 60 and 70 million. But even if we split the difference there and say, okay, we're going to have a market cap of 65 billion, that means that it would be trading at a price to earnings of 122, which is crazy because NVIDIA obviously has a massive valuation. It's 197 price to earnings ratio. But NVIDIA is growing. Like it has a significant amount of growth for something, that's chip based. As I mentioned in the last segment, this company isn't really growing. It is becoming increasingly profitable and it is expanding out its margins and it's incredibly dominant, but it almost looks like a value stock. This is not a growth stock. You can't have a 1% revenue decline and say we want to trade at a valuation of 122. So I definitely think this is a hype play. Because it has a monopoly, obviously it's not going anywhere, but it's certainly not going to be growing at an AI pace because it doesn't have the exposure to that type of market. And that was kind of backed up by something that independent analyst Richard Windsor said. He publishes Radio Free Mobile, and he said that Arm's profile looks more like a smartphone chip specialist like Qualcomm than NVIDIA. While NVIDIA stock has rocketed this year in AI excitement, Qualcomm has traded almost flat, held back by concerns of the slowing smartphone sales, which is also what I mentioned when we were discussing the prospectus, that there is slowing sales in China. Likely those sales are going to that slowdown is going to expand out to the rest of the world. There's just incredible market penetration in the smartphone market right now. So yeah, it's definitely a hype play, I would say.
Yeah, I also saw some funny stuff there where SoftBank bought some shares from the Saudi Vision Fund.
Yeah.
Oh, no, sorry, the SoftBank Vision Fund, which is backed by the Saudis, and they bought it at a $64 billion valuation, and then I think they're looking to recoup it in the IPO. So there's some funny stuff going on, basically. It doesn't really fill me with confidence. I know people are saying this is kind of the harbinger of a new IPO market and stuff, but I don't know. My suspicions are a bit hankered. What do you think?
Yeah, there's just too many weird little red flags. I mean, it is impressive to think that you could bring a $60 billion company IPO at the minute. Like, that is nice to see. Okay, there's an interest for companies that have lofty valuations that are in these spaces, but I do think it's kind of a money grab. That would be my instinct.
Yeah. Okay. So that's the ARM IPO. Okay. If you like listening to us, you're going to love reading from us. We're delivering to your inbox one of the most unique products on the market, and it's completely free. No one else is covering the markets we cover with Charging and Fearless, where we deliver to you a weekly stock pitch that could be from anywhere in the world. So that is a completely free stock pitch every week. You'll have it read in about 30 seconds flat, and we can almost guarantee most of these companies are going to be brand new to you, which is where you get an edge in investing. So sign up now in the show notes for today's episode. Okay, big deal or no deal? Emmet, I'm going to start with you and the payments processor and Stripe rival Adyen. So it fell about 50% since last week's earnings reports, last week's Q2 earnings report. Big deal or no big deal?
Yeah, Adyen is a leading European payments company. And if you've ever waved your phone in front of a Pi terminal, especially in Ireland anyway, to pay for something, you've probably interacted with their architecture. Well, they reported lower than expected earnings and revenue in the first half of the year due to competition from rivals such as Stripe and a hiring spree. And as you said, Mike, shares dropped about 50%, which knocked 25 billion off the company's market cap. And it's really the talk of Bloomberg and CNBC. And I would leave the business TV channels on in the background if I can. And it's just been the hot topic over the last 2 days on television. And basically, analysts are concerned that Adyen's performance in the US was poor. Like, the revenue growth was less than half the growth rate of 2022. And the business blamed the shortfall on higher inflation and interest rates, which prompted its North American digital customers to concentrate more on cost savings as opposed to growing. So their customers are all about rolling in a ball as opposed to expanding outwards. And I don't really like how external that is. And what I mean by that is, when a company blames the weather, just tongue in cheek, when you see a company blame the weather, it's like, is it only something that's so far out of your direct influence? And when you think about inflation and interest rates, it smacks of there's nothing we can do about this. And I think the real reason for this is mostly competition in the payments sector is increasing. There is no short of payment tech companies out there. They're growing. I also might say, before I get on to answering your question, I noticed that Cathy Wood's ARK Invest has, did it say doubled their stake in Adyen? Did you see that, Anne-Marie?
Yeah, I also know that there was a bit of confusion around the figures because Adyen has changed the way it reports revenue.
Yes, correct. So
Yeah.
They went from gross revenue to net revenue, isn't it?
Yeah, that's right. Which of course could be misunderstood, and it takes I suppose when a company restates how it talks about its numbers, everyone is used to just looking at one number, and if it falls off a cliff edge for a new reporting reason, that also has to be considered. Big deal or no big deal? I know it's a digital. We talk a switch. It's like a light switch. It either is or isn't a big deal. Part of me thinks it's a big deal because the competition is increasing. And then part of me feels it's no big deal because fundamentally the business is still one. I don't want to call it a duopoly, but they have an integration, a tight integration with Shopify. I think their future is very certain. So if you said, is it a big deal from a perspective of the growth? Yes. Is it a big deal from a company going to survive? I say no. Okay, so which I'm going to say it's a big deal. I think it's going to take a while to recover, but I don't think it really is a big deal when you keep your eyes to the horizon, which we all have to do. What would you say, Anne-Marie?
I think it was a bit of an overreaction. I think the sell-off, a couple people wonder online yesterday if the massive, like a 50% drop is significant. And some people were wondering if it some of that could be credited to like robo traders, which when the change happened to the way revenue was reported, it meant if you just like looked on a quarter basis, it looked like the company like fell off a cliff. And they were wondering, did that trigger a bunch of automated trading that then sold off the stock? Because a 50% drop is, for a company so large, that's crazy. Like that is like very akin to like when Netflix sold off, what was it, beginning of last year, because it had the like 1/4 of subscriber drop, and it just like half the market cap was gone. And we were all going, but Netflix isn't going anywhere. So I do think it might be an overreaction. And in that sense, it's maybe a little bit of a big deal, because is there an opportunity there for Adyen? You know, is it worth a look?
Would you buy today, Anne-Marie?
I have to go in and have a look at the valuation and have a look at its figures and listen to some calls. I haven't checked in with them in probably 6 months. But like, as you said, it's like, it's so embedded in its infrastructure. It's not going anywhere.
No,
so
it's definitely not.
And all the growth issues are coming from the US, where it's been forced to grow because it almost has the market saturated in Europe. But yeah, it's got a very strong base there. I like your theory on the robo investors. It's a little tinfoil hatty. Sounds good.
Yeah.
Anne-Marie, so we're moving on to Instagram threads. So billed as the Twitter killer, it's not really playing out as such. So engagement has basically fallen off a cliff since its launch. Usage is down 79% in August compared to July. So big deal or no big deal?
Big deal. I think if you're a Meta holder and you were thinking, okay, this is the second age of Meta dominated social media, I don't think that I personally don't think the space is going to survive. I'd say within a year it will be shut down due to lack of use. I think it's kind of down to some of the factors that we talked about, like when it launched, which was branded content came onto it very, very quickly, and there was a lack of a kind of community element. You know, we talked about the fact that a number of like influencers, or I suppose culture creators on existing Meta platforms such as Instagram, probably wouldn't translate very well to a text-based medium. So it just meant that like there's no real reason for the average user to be there unless they want to use it like 2007 Facebook. So just a few of the numbers there in terms of this Threads drop. Within the first few hours of its launch on the 5th of July, Threads garnered 5 million users. And then within a week, that had ballooned to about 100 million users. However, its daily active users hovered around 49 million at peak. But by August 1st, that number had cratered to 9.6 million. So that's a daily active user drop of about 82%, which that's pretty astounding. And that has kind of continued through the month of August. We're seeing daily active users drop about 1% every day. So just that kind of slow death of the platform. Engagement figures are also down significantly. So data shows that usage of the app peaked on July 6th at about 14 minutes a day. And that has come down to about 2.3 minutes per day on average. And it is worth mentioning that, like, even at its peak, 14 minutes a day is not that long. Like, I think average usage of TikTok is in the hours. I think it's over 2 hours for young people. So that's really not a monetizable space, to be honest with you. Like, there's no money there. And even like Twitter, which has become just the bedlam of the internet, continues to average more than 100 million active users a day. So, you know, even the thing you're trying to kill is outperforming you. God, by a measure of 10x now at this point. So, yeah, unless they improve something dramatically, I can't see this going on for much longer.
Completely irrelevant, but I quite like Instagram Threads. It's not like this cesspit of grot, which I found TikTok to be. It just kind of it's just small laughs. You know, it's just lots of funny little videos. That's what serves me anyway.
That's Reels.
Stuff. What?
That's Instagram Reels.
Oh, what? Oh, right. Sorry. Now I know what you're talking about. Twitter. Oh, I'm so down with the social media kids. Yeah. Right.
Yeah. Okay. We haven't gotten access to Threads yet because they didn't want to do the GDPR regulations with the EU. So we can't use Threads. We haven't seen it.
Oh, I'm Scarlet.
Scarlet.
By the way, for our American listeners,
I was thinking, where did you get access to Threads?
Right. Okay. Moving swiftly on.
Okay. Moving swiftly on is right. Okay, we're just going to finish off with a quick message from our sponsors and friends at Vodafone Business. So if you're an Irish business looking to get ahead in the digital journey you're on, Vodafone Business is the place to go, especially with their recently launched V-Hub digital advisory service. So with this new service, businesses of all sizes can get free one-to-one digital support and advice tailored to their business by simply booking a call with one of their digital experts. So either go to Vodafone Business website or search Vodafone V-Hub for more information. I'm Marie and Emmet. Thanks for joining me today, and thanks everyone for listening. If you have any questions you'd like answered or elevator pitches you'd like us to tackle, make sure to get in touch. You can find us on TikTok at MyWallSt, on Twitter at MyWallStHQ, or simply just email us at pod@MyWallSt.com. If you're enjoying the show, leave us a review, share us with your friends, and we will talk to you next week.